If you've been following the Sydney and Melbourne real estate market recently, you've likely noticed that property prices in these two cities have been stagnant for almost a year. Many of our followers have been asking us, when will Sydney and Melbourne property prices start to drop? I couldn't give a definite answer because there were no clear signs. However, recent indicators suggest that the Sydney and Melbourne property markets might actually enter a downward phase in the second half of the year. In this video, we'll analyze how these indicators might signal a downturn in the Sydney and Melbourne property markets, whether they will enter a decline, when it would happen, how long it could last, and how property investors should adjust their portfolios. Never sell your investment properties unless you have these 6 reasons. Hi, I'm Alex. Welcome to Oz Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Indicator 1. Decline in asking prices. Recent data from SQM Research shows that in the month ending August 13th, asking prices for houses in Sydney dropped by 1.5%, while apartment prices slightly increased by 0.2%, resulting in an overall decline of 1.1%. In Melbourne, housing asking price fell by 0.7%, with apartment prices rising by 0.7%, leading to an overall decline of 0.5%. These statistics include properties that failed to sell at auction and were subsequently listed for private sale. This data aligns with recent trends in auction clearance rates. On August 18th, Sydney's auction clearance rate slightly improved to 74.6%, while Melbourne's remained below 70% at just 67.4%. This trend is directly related to the increasing number of properties being listed for sale in Sydney and Melbourne over the past few months. Asking price is a highly reliable leading indicator. A decline in the asking prices of properties listed for sale today is likely to be reflected in lower actual sale prices in the coming weeks or months. This indicator reflects a lack of confidence among sellers. When confidence is low, sellers are more likely to set lower asking prices and accept lower offers. This is the current situation in the Sydney and Melbourne markets. Therefore, the decline in asking prices observed in August could lead to a softening in property prices in the third quarter of 2024 in these cities. We will discuss whether this trend will continue into the fourth quarter or even the first quarter of 2025 shortly. It seems that sellers are worried about not being able to sell their properties now, reflecting a lack of confidence, while buyers are hesitant to make offers. It is possible that previously affluent buyers are now facing high living costs, increased interest rates, reduced borrowing capacity, and diminished cash reserves, leading to a decline in both their willingness and ability to buy. As seen in the graph, while Australian property prices have been rising since the second half of 2023, people's purchasing power has been decreasing. These two factors combined have created the current market conditions in Sydney and Melbourne. Indicator 2. Decline in rents. According to data from SQM Research over the 30 days ending August 12th, the average rent across Australia's 8 major capital cities dropped by 0.5%. Rents in Sydney decreased by 1% and in Melbourne by 0.6%. Surprisingly, Brisbane and Perth also saw rent declines of 0.5% and 0.6% respectively during the same period. Most people understand the drop in Sydney and Melbourne rents as the reduced number of immigrants and international students has lessened the competition in the rental market. However, the situation in Brisbane and Perth was unexpected. We'll need to keep monitoring this to determine whether this is just a temporary dip or the beginning of a trend. It's important to note that a monthly decline of 0.5% to 1% is almost negligible compared to the annual rent increases of around 20% since 2022. This slight drop may simply indicate that the supply and demand in the rental market are starting to balance out. Another point worth noting is that not all areas within the city experience the same level of rent decline. We're talking about an average. Some areas may see rent increases while others experience decreases, leading to a slight average decline. Areas where the drop is more pronounced include city centres and coastal regions. For example, the rental market in the CBD of Sydney and Melbourne has noticeably weakened. On the Gold Coast, rents fell by 1%, and in Melbourne's Mornington Peninsula, rents decreased by 1.4% in just 1 month. These trends are also reflected in vacancy rates. Although the overall average vacancy rates in each city are still very low, there are significant differences when you zoom in to the council or suburb level. In Sydney CBD, the vacancy rate has surged to 5.5%, and in Melbourne CBD, it has reached 4%. Brisbane CBD is doing slightly better with a vacancy rate of 2.5%. But what does it mean? For renters, a 1% vacancy rate means it's nearly impossible to find a property. If you like a place, it's usually snapped up by someone else, and you might have to bid aggressively to secure it. At a 2% vacancy rate, the pressure eases a bit and your chances of finding a place increase. Once the vacancy rate hits 3%, it becomes a tenant's market, where you have more choices. Now imagine a 4% vacancy rate in Melbourne's CBD and 5.5% in Sydney's CBD. The pressure to find a place practically disappears. Supply is clearly outstripped demand, which is why landlords are lowering rents to compete. If vacancy rates continue to rise, more landlords will be forced to reduce rents. For those holding investment properties, this raises concerns about cash flow, which could increase the pressure to sell, leading to more properties being listed for sale and ultimately reflecting a decline in property prices. Indicator number 3, 90-day property price drop. The third indicator we often use is the rolling 90-day property price chart. We don't choose to use the 30-day price because while it shows what has happened in the short term, to identify a trend, you need to extend the time frame. The 90-day chart smooths out short-term fluctuations, making it easier to spot trends at a glance. In the 90-day chart ending July 31st, we can see that Melbourne's prices have started to turn downward, showing signs of a decline, while Sydney's trend is not as clear. However, historically, even when a trend appears, there is always the possibility of a sudden reversal. For instance, changes in immigration policy, lower interest rates, or easier access to loans could quickly alter the market's direction. Both of the 90-day price and 30-day rent are lagging indicators, meaning they reflect what has already happened. They help us understand the past events, but it's challenging to use them to determine what is happening now or what will happen in the future. This is different from the asking price, which is a leading indicator, and it can more or less predict the future. So the question arises, if you own an investment property in Sydney or Melbourne and see no signs of a price rebound, and with all the current indicators pointing to a tough period ahead for the market, should you sell your unprofitable property and reinvest in a more profitable one in another state or territory? This is a question we've been asked a lot recently. There are only 6 situations where selling an investment property is advisable. If none of these 6 situations apply, then you should never sell. 1. Urgent need for cash. If you suddenly find yourself in a tight financial situation and need cash urgently due to unexpected circumstances, and neither friends nor the bank can lend you the money, selling your property may be the only option. However, because you are in a rush, you might have to accept a price below the market value, and if the market is also in a downturn, it could be even worse. In such cases, selling because of an urgent need for cash often means limited profits or even losses. But if you had another option, you probably won't sell your property, right? This is why cash flow planning combined with emergency funds is a defensive strategy every investor should employ. At Also Property Strategy, we offer our Vision members cash flow red line management and recommend keeping an emergency fund equivalent to 12 to 24 months of expenses to ensure that you can hold onto your property for the long term, benefiting from compound growth without being forced to sell at a loss due to cash flow issues. 2. More effective use of funds. If you're confident that you can invest your funds in a more profitable venture, it might be worth selling your property to buy another property or asset. This situation is more common during a property market upswing. Investors holding a loss-making property often wonder whether they should cut their losses and sell it. The answer is that if you can use the funds more effectively, then selling could be a good option. You need to calculate the potential outcomes over the next 10 to 20 years in 2 scenarios. 1. Holding on to your current property and selling it in 20 years. What will your net profit or loss be? 2. Selling now and reinvesting in another property. How much could you earn in 20 years? If the second scenario shows a better return, then it's worth considering selling the current investment property. The challenge lies in your ability to do the math and predict the future variables such as property appreciation, your capacity to hold the property for 20 years, and considerations of policies, economics, and taxes. This is where Also Property Strategy excels. For our Vision members, the first step is to review and adjust their existing investment portfolios as needed. 3. Reducing holding pressure. A typical situation is when you own 5 to 6 investment properties with leverage maxed out. With low interest rates, holding these properties might not be stressful, and you might even have positive cash flow every month. But if interest rates rise, say from 1% to 7%, your cash flow could shift from positive to neutral and then to negative, eventually leaving you without enough cash to cover the mortgage payments. In such cases, you may need to consider selling a property to reduce your repayment burden. Our Vision members rarely face this situation because we conduct annual portfolio reviews and track the market in real time. As soon as there are signs of change, our members are the first to know. The ideal scenario is that you have a good grasp of economic trends, monitor your investment portfolio in real time, and can predict potential cash flow pressures 1 to 2 years in advance. Number 4, misalignment with investment goals. Everyone's investment goals are different. Some want to make quick money, while others aim to make a little and then spend it, with many short-term goals in mind. In my view, property investment goals should always be long-term, extending to retirement and even beyond, to the later stage of life. Achieving passive income through property investment sufficient for retirement typically requires 10 to 20 years of consistent investment. In the early stages, you need to buy high-growth properties, and in the later stages, high cash flow properties. If you're starting out and have purchased a property with good cash flow but low growth potential, this might not align with your investment goals and may require adjustment. 5. Overconcentration of investment. Some people prefer to concentrate their investments, essentially betting on a single outcome. Others prefer to diversify, holding long-term investment to earn average market returns. I belong to the latter group and recommend this approach to our members as well. While it may not bring as quick or as large returns as concentrated investments, it offers stability and durability with less need for active management. If you have a gambler's mindset, you might lean towards putting all your money and loans into a single type of property, but be prepared for the possibility of a bad bet. Most people have a lower risk tolerance and are better suited to a diversified investment approach. If your property investments are overly concentrated, it might be time to make some adjustments. 6. Changes in economic fundamentals. Consider China in 2021. If you had money, would you have bought a property? Many people would have said yes. But would your answer be the same in 2024? This shift is what we mean by a change in economic fundamentals, the big picture. This includes factors like population, output, finance, and the overall sentiment and perception of society. Currently, there are no signs that Australia will undergo such a fundamental structural shift anytime soon, so this reason for selling is unlikely to be relevant in the near future. After discussing all these, will Sydney and Melbourne property prices really drop? In any city, price fluctuations are entirely normal. One of Oz Property Strategy's core investment principles is well summarized. The Australian property market has short-term fluctuations but long-term growth. This conclusion comes from our comprehensive study of the Australian property market data of the past 50 years. So a short-term decline in the property market is normal. Based on the asking price indicator, it is highly likely that Melbourne and Sydney's property markets will weaken in the third quarter. As for the fourth quarter, unless there is an unexpected event, I guess this trend will continue. What could change this? The answer lies in interest rate cuts in Australia. Do you remember earlier this year when everyone speculated that rates would be cut in March? Now the talk is about March next year. Even economists are divided on this. I hope the RBA cuts rates tomorrow, but rising unemployment and inflation don't support that move. We can only wait. Without rate cuts, other policy incentives, or unexpected events, I believe the property market trend in Sydney and Melbourne will continue to weaken. As for whether you should sell your investment property, you can refer to the 6 points I just mentioned. Review your situation and feel free to consult with us. A few seasoned investors might start seriously looking at Sydney and Melbourne property markets for bottom fishing opportunities right now. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.